monetary versus regulatory functions for the Fed. And you talk, page 92 I know it is, you talk about the fact that monetary wasn't really the approach that needed to be taken when it comes to the bubble in mortgages. And, and you say, in a 2002 speech, I'd said that financial regulation and supervision should be the first line of defense against asset price bubbles and other risks to financial stability. Has that been corrected now? There was a regulatory fail, wasn't there?
Yes,
that led
absolutely.
to this? And has it been corrected, and has it been overcorrected?
Well, that's an awful lot to chew on here. So I think the critique of the Fed prior to the crisis, I mean, a lot of it is focused on monetary policy. People who have looked at it carefully generally agree that monetary policy was not the main reason for the housing bubble. But one of the ways the Fed was responsible was, with other regulators, it didn't do enough to prevent the bad mortgage lending. And there's a lot of reasons for that. You know, one reason was that there was this very strong political support for subprime lending because it was creating home ownership so broadly. So I thought that was the main.
I'd love to just back that up. The strong political support. So Barney Frank, for example, who has been so critical of bad bank behavior during the financial crisis, specifically around mortgages, would you say it was Barney Frank who was promoting this? It's part of the American dream, your birthright here to own a home.
It wasn't Barney alone. I mean, the regulators were saying, you know, we want to take care of predatory lending. We want to get rid of that. But subprime lending is positive because it improves home ownership. So it was a goal that a lot of people were pursuing, and in doing so, some bad practices were not taken care of.
I think if you look at it, it goes well back into the 90s, and HUD policies and things to really encourage home ownership, particularly by lower income people.
Right.
It was thought it was good. And
to answer your question, at least those specific things I think have been addressed pretty significantly. In fact, I've had a lot of complaints about mortgages being too hard to get now. The other thing that we've done, or we, the regulators, the country has done, is made the system a lot stronger. So capital in the banks is way higher. You know, and generally the system's much more resilient than it was.
And John, I think you've said that you thought that there was not enough regulation as well going into
this. There's no question about it. I think Ben has hit it right on the head. It was political. It got out of control. It got too easy. Securitization became almost a machine running securitized products out. And there wasn't enough oversight, and there was a lot of fraud. And, you know, when everyone's happy and the market's going up, I think it actually gets worse on being sloppy in how things are done. It's totally changed now, and that's what we need. But again, politics had a lot to do with it. And look, it's great if people own homes, but it's got to be a situation where they can afford the home. There's no lying and cheating. You can't have 4 or 5 homes, which some people did, playing the mortgage game.
And they were flipping them.
Absolutely.
Yeah, but politics don't go away. Politics are always with us.
Sure.
So politics plays some role, I suspect, in the regulation now that's come to bear.
Yeah, but much more so on let's make sure this doesn't happen again. You're not getting the big push if you go back 8 or 9, 10 years ago that we were getting. So it's gotten a lot better in my view.
Is there any risk that the rescue intervention in 2008, could we possibly look at it, because we're not in that much better of a situation today, that really maybe we just kicked the can down the road and it wasn't necessarily an absolute rescue?
Well, that's a great question.
I disagree with that.
Do you think we
All right, hold on.
I disagree with it. I mean, Ben mentioned it earlier. The amount of liquidity in the banks, the lower leverage ratios in the banks, I really don't see how this could happen again unless that changes. The speculation that's going on the street is dramatically lower than what it was back in 06, 07, and the beginning of 08. I just don't see that.
But do you see our economy doing that much better today?
Well, look, it takes a long time to get out of the hole we were in. But, I do think, look at our economy vis-a-vis the rest of the world. I think we're doing pretty well.
So, Matt, we're going to go to the Bloomberg.
I've got something here. In fact, Bloomberg has a great screen, FCON, Financial Conditions, a dashboard that allows you to see the state of the economy as it is now and historically. And if you take a look at the financial conditions and zoom in on this proprietary index that we have, it puts together a number of market prices and a number of different inputs to show you sort of the cost and availability of credit. You can see that we've had actually a huge recovery since the financial crisis. And in fact, we've been staying sort of above the zero line. In 11 we came down again with the correction in the market, but we've been good since then until just the last few days. I mean, if you click on financial conditions, you can get a bigger picture of the index and see that just over the last few weeks we've come back down below zero. And I wonder if it's going to take us this long to recover from that, a whole quarter to recover from that, if we're going to recover from that in a quarter.
Ben, you want to weigh in?
Weigh in, exactly, on Stephanie's contretemps with John.
Well, I just look at that picture. I mean, the stress in 08 was unbelievable, and our economy was a great risk. And as John was saying, the U.S. has done much better than any other industrial country. We're about 10% above the highest peak of our GDP before the crisis. Europe is not yet back to the pre-crisis level.